Since the middle of April, we've seen the Australian share market fall by about 15% towards the end of May, and the catalyst for this has been markets continuing to focus on the current debt levels within Europe, but more specifically the potential for default by a number of countries. This is an issue we've been focused on for some time, and it's basically come about because of the large spending programs a number of countries have run in recent years in order to sustain or generate economic growth. And this has resulted in large budget deficits, as well as the accumulation of larger levels of government debt relative to GDP. And Greece is probably the best example of that. They've due to run a budget deficit this year of over 10%, with debt to GDP already running at 120%. But what's focused the market's attention more specifically in recent months other countries like Spain, Portugal, Italy and Ireland, which are also running similar debt to GDP levels and budget deficits. One of the key implications these events are going to have for investors globally is the impact on global economic growth. The European Central Bank has put together a €750 billion funding package, which basically removes the concerns of rolling short-term debt for these governments, but it doesn't change the underlying structural issues these governments face. That's the budget deficits they're running, along with the level of aggregate government debt that they've accumulated to date. These governments are going to have to make massive cuts to their spending programs, and that's going to directly impact the level of economic growth they're going to generate in the coming years. And that's going to obviously have material impact for investors globally. There are three things we focus on at Fitzpatricks when investing client money. The first is capital preservation. The second is to always focus and understand the risks we're taking. And the third is to try and achieve a more stable, predictable investment outcome over time. If we look at the second element, focusing on risk, one of the key risks we're conscious of is the level of market risk in the portfolios. Market risk is the sensitivity of the portfolios to change in the equity markets. We achieve a much lower level of market risk in the portfolios to what the industry generally has by holding a number of investments that typically generate positive returns in falling equity markets. Whilst market risk still remains a core part of the portfolios, it's very, very important that it does not dominate the overall risk of the portfolios. Given the portfolios inherently don't have the same level of market risk as the industry, it means that the underlying portfolios aren't as driven by equity market moves. And we saw this through 2008 when the portfolios generated positive returns whilst the market was down 40 to 50%. So it's a massive difference there in investment returns. Through 2009, the portfolios continued to generate positive returns, but the market also bounced strongly during that time, and so that material outperformance that occurred in 2008 was whittled away. But over the 2-year time frame, the portfolios continued to have generated positive return. And if we look at the last 6-8 weeks, as well as the market's fallen off, we've seen again that positive absolute return focus of the portfolios coming to the fore.